Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Brainaurora Medical Technology Limited annual report. Brainaurora Medical Technology Limited offers a wide range of medical technology solutions for various healthcare needs. The company's primary focus is on developing digital therapy (DTX) products to treat cognitive impairments caused by vascular diseases, neurodegenerative diseases, psychological disorders, and child development deficiencies. The company provides several software systems, including the Brain Function Information Management Platform, which is an evidence-based medical-grade DTX product. Other notable solutions include basic cognitive testing software for assessing patients' basic cognitive capacity, cognitive ability supplemental screening and assessment software to facilitate healthcare professionals' assessments, and dyslexia supplemental screening and assessment software to identify developmental dyslexia in children. In addition to these specific software systems, Brainaurora Medical Technology Limited also develops solutions for COVID-19-induced cognitive impairment, ADHD assessment and treatment, quantitative cognitive assessment for depression, depression treatment, and cognitive impairment assessment and treatment. These products cater to a broad range of healthcare needs, from neurological disorders to child development. The company's services extend beyond software development, as it also provides marketing services to support its medical technology solutions. With its headquarters in Shaoxing, China, Brainaurora Medical Technology Limited has been serving the Chinese market since 2012. Brainaurora Medical Technology Limited maintains a market capitalization of $6 billion, broadly in line with the industry peer group. Brainaurora Medical Technology Limited trades at a higher price-to-book ratio of 18.95 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 177% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, rapid business development, increase in user numbers, expansion of commercial partners, provision of integral software solutions in hospitals, medical artificial intelligence language model solutions, and new customer acquisition all contributed to revenue growth. For instance, the company's sales of medical AI language model solutions generated an additional RMB 49.78 million in revenue. On the other hand, research projects and decrease in allowance for credit losses were the primary drivers of revenue decline. The reduction in research project revenue from RMB 15,942,000 to RMB 12,134,000 had a significant impact on the company's overall revenue. Additionally, the decrease in allowance for credit losses also contributed to the decline in revenue. The growth and decline drivers highlight the importance of diversifying revenue streams and managing various business aspects effectively. The company's ability to adapt to changing market conditions and capitalize on emerging trends will be crucial in sustaining its revenue growth trajectory. Based on the provided information, it is clear that the company is indeed generating positive operating cash flow. This is confirmed by two separate sources, page 27 and page 54, which both state that the company's operating cash flow is positive. Page 27 explicitly states that the company is generating positive operating cash flow, while page 54 provides a specific figure of RMB 38.41 million for the operating cash flow, further solidifying this conclusion. Therefore, it can be confidently stated that the company is producing a positive operating cash flow. The company's financial health has undergone significant changes. A notable increase in debt levels has been observed, with bank and other borrowings rising from RMB 21,261 to RMB 346,089 million. This substantial growth is evident across multiple pages of the report, including page 7, 32, and 52. As a result of this increased borrowing, interest expenses have also seen a significant rise. Total interest expenses have grown from RMB 22,000 and 25,000 to RMB 23,000, 986,000 on page 15, while finance costs have increased by 8.9% from RMB 22.03 million to RMB 23.99 million on page 52. These increases are primarily attributed to the rising interest on bank borrowings. The reported debt level and interest expenses of 0 in 2025 on page 53 is likely an error or formatting issue, given the substantial growth observed elsewhere in the document. The company's financial performance can be analyzed through its operating segment and regional non-current assets. The only operating segment is providing cognitive impairment digital therapeutic software solutions, indicating a focused business strategy. In terms of revenue generation, all sales come from customers in mainland China. Looking at the non-current assets by region, it is clear that Chinese mainland has performed well, with an increase from 44,499 RMB 0 to 48,604 RMB 0. This suggests a strong presence and growth in this market. On the other hand, Hong Kong has performed poorly, with a significant decrease from 4082 RMB 0 to 9852 RMB 0. The performance of Japan is unclear due to only one data point available for 2025. The regional analysis highlights that mainland China is driving growth and success for the company, while Hong Kong appears to be struggling. Management's outlook for the company is optimistic, with several key goals outlined for the short term. By the end of 2027, the company aims to achieve commercialization, with specific targets including the commercialization of its cognitive impairment digital therapeutics product by Cone 2027 and medical device registration certificate for depression treatment software by the end of 2028. In terms of product development, significant milestones are expected in 2025 and 2026. The company plans to complete a clinical trial study for quantitative cognitive assessment software in Q3 2025, with commercialization anticipated in 2026. Additionally, clinical trials for depression treatment software will begin in Cone 2026. The company also sees opportunities for market expansion, particularly in the US and EU markets, where it plans to develop products including cognitive impairment assessment software and treatment software. Overseas expansion of digital therapeutics is seen as a growing trend, driven by the need to address cognitive impairment diseases globally. Industry trends suggest that the market is shifting from symptom relief to source prevention and control, presenting opportunities for companies that can adapt and innovate. Management recognizes the importance of participating in industry standard formulation, which will give the company a significant advantage in the market. There is no notable activity in terms of acquisitions or divestitures. The company has not made any significant purchases or sales of assets, subsidiaries, or businesses during the period under review. This suggests a stable and focused approach to business operations, with no major changes in its portfolio or structure. The company's financial policies have been scrutinized in recent reports. One notable aspect of their strategy is the decision to forego dividend payments. This means that shareholders do not receive a portion of the company's profits in the form of dividends. In contrast, there is no information available on share buybacks. This omission suggests that the company has chosen not to repurchase its own shares from the market. That concludes the financial summary for Brainaurora Medical Technology Limited. Feel free to comment below, and I will be happy to answer them when possible.